Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's most likely going to be related to three different topics: financial topics, commodities, and or uh, wealth building. Almost forgot the third. So let's dive in there. Let's see what people are talking about. If you want to follow me at Finance, and if you want to join our community, finding-value.com, that is where I dive into the sectors, portfolio position sizing, weighting, natural gas, everything, guys. We talk about all the different types of stuff. I look at charts. I do technical analysis. And I would like to think that I am very good at picking stocks at very opportune times that provide the most amount of leverage to the price move. I'd like to think that at least. All right, so coming down, U.S. total liquids with SPR is down 31.26 million barrels since the start of the year. The implied balance for just the U.S. is minus 0.4 million barrels per day. So we are drawing, or we have a deficit of minus 0.4 million barrels per day. And here we are in 2024, far below everything else when you look at the total liquids stockpile with the SPR. So we've drawn down inventories already to get us to where we are at today. Now, looking at the other chart, let me zoom in a little bit there. The other chart on the right-hand side is EIA total liquid stockpile in 1,000 barrels. This is without the SPR. So with SPR, obviously we had a lot of inventory up here in previous years. But if we were to take into account just the commercial inventory levels, this is what's pricing the oil and gasoline and stuff. It's on the right. This is commercial inventories. And commercial inventories were low, and we are declining, but we weren't below 2022, at least not yet. But we had to basically steal it from over here, put it into the commercial, and just account for it differently. Quote, account. So we've done the accounting, and now I don't know if we're going to take any more from over here and shift it into commercial stockpiles to try to further keep oil prices down. I don't know if they're going to do that or not. I'm willing to bet if it gets high enough, they will. And we're going to be put in a very bad situation where prices could really accelerate. This here is the most important commodity on the face of the planet, which is oil and gasoline and diesel. That is what moves. That is what a lot of things are made out of in terms of paints and all this other stuff, glues, everything. There's so much stuff. So this is very important to follow and watch. Here's the U.S. weekly implied oil demand. That was the supply we were looking at. The demand is now above 20 million barrels per day. There we are in 2024, and you can see 2020 was a little bit higher, along with 2022 was a pretty strong year for demand. And we'll see if this jumps up into these other weeks and how high we go. Shabam says Canadian crude inventories, and I don't really follow Canadian crude, so I think this is interesting. Looking low already with another 8 million barrels to be used for line fill over the next couple of months. And the dark red line is where we are in 2024, and we're lower, we're on the low end for Canadian observable onshore crude inventories. Which is this is good if you're an oil investor. This is going to be bad for everyone else, because if you're not long oil, then you're going to be paying for more for everything. It's going to be inflationary. So here's Western Canadian Select. I was just saying, well, if this is low, I bet you the spreads are tightening. It hits a 52-week high as TMX line fill commences. And here we are rolling on up for Canadian crude index. And there's generally a disconnect. It's the heavier oils up in Canada are a little bit cheaper than some of the other oil located in the world because of egress of that oil to get it away from the fields to somewhere else has been historically a lot more difficult. So there's always been a discount on Canadian crude oil. We have these lines being built, the TMX Trans Mountain line going up, and that's going to, I think, close the differential. And that's another reason I really wanted exposure up to a lot of these Canadian oil companies. Also, natural gas, I think, will eventually move higher as well as liquefied natural gas terminals go up and more pipes get built over time. Going down to Sahara, we've got gold here. Powerful conclusion to the bull plot. So we have a big, gigantic bull flag that we've broken out to the upside. This looks absolutely excellent for anyone that's looking at this. And yeah, I think we're going higher, is what this chart is suggesting. Breakaway is saying dry bulk was down about 3% for Capesize and Panamax, and tankers were down 4% for VLCC. Just an FYI. JC Parrots, it says, look at that base in silver. So we've got a base here that has developed in gold that has broken out to new all-time highs. We've got silver also creating that other base, just like gold, and we're breaking the downtrend line here any second. So silver, I think, is going to follow gold, and it's going to be probably an incredible move out of silver. I am extremely excited about silver, and I think some of these gold, silver mining companies are just going to do crazy things here. At least that's my hope. I don't know for sure. No one knows for sure, but they are incredibly cheap against gold and silver. The mining companies are. And if we can get a full revaluation to the opposite end of the spectrum, where gold goes up a lot and silver goes up, the physical metals, and we get on top of it the full revaluation from cheap to expensive, oh my goodness, guys, the mining companies, if that were to occur, would be a ridiculous return. I mean, ridiculous. Because some of these are off the chart cheap. Grady says, this chart shows lumber having backtested huge support for a third time, this time with increasing volatility, gathering energy. The pushed narrative is inflation is done. No, it's not. Gold often leads lumber, and gold has now broken out big time. Lumber's moving up because we have to build a bunch more new homes. We're in the middle of the expansion phase of real estate. This is what I've been talking about, and this is going to drive inflation and commodities higher. We're right in the middle of this big wave, guys. And I don't know how to emphasize how big of a deal this is and how much of an opportunity it is. The opportunities here are so big because commodities move so fast in such a short period of time that the opportunities are just absolutely insane for creating and building wealth. EIA weekly oil report. So this is the total U.S. just oil inventories are at level of 2004. Now, here's one thing I really want everybody to focus in on. I'm going to zoom in on this, all right? Maybe not that much. In 2000 to 2008, we had a oil price that went to, what was it, like $20, $10, all the way up to $140. Look at what the total U.S. oil inventory did during that time frame. It went up. It went up a lot. We peaked in 2016 and then another peak in 2020. And then we've basically broken that uptrend line and have been going lower and lower and lower, which means we're just sucking through all of our inventory. Our buffers are going to be tighter in the world, our inventory buffers. And if we are at pumping capacity of the world, oil is going to probably be one of the best investments out there because it's the number one commodity and a lot of businesses need it in order to operate. And people. I mean, people are going to say, well, how am I going to get to work? It's like, yeah, you're just going to pay it. I mean, that's really what it is. And then you're going to have demand destruction where people are going to start to potentially, I guess, buy more electric vehicles or something if the price gets too high. I don't know. Or start biking. Art Berman. So here, this is where I want to tie this in here, guys. This is really important for oil. He says tight oil production seasonally lower at 7.85 million barrels per day in January, or 62% of the U.S. output. The Permian production accounted for 5.23 million barrels per day, or 41% of U.S. output and 67% of tight oil production. Now, look at this. What's with this decline here, guys? We went from 13.25 to 13.22 to 12.62. Is this the beginning of a potential move lower, or is this just normal variation? I don't know, but you know what? I'll continue to monitor it. If we start to go lower here, I don't see how oil doesn't go way up. And when I mean way up, if we start to go lower and people figure out that maybe we don't have the production capacity that everyone thinks we might have, I'd be interested to see how high oil goes, and I'd also be interested eventually to see how high gold and silver and these physical metals go. It is my idea or belief that whenever you get credit creation and whenever you have a tight energy supply, that people are going to start to worry about the bond market and currencies market. I think that's what we are beginning to do right now. It's always best, in my opinion, to panic first and get whatever you need before other people figure it out. And I don't know if this is the peak here in total U.S. oil production or not, but we can see that the Permian's at 807 to 7.85. Tight oil looks like it's holding steady, and the Permian maybe is starting to roll over. I don't know. We'll continue to monitor it, and I think this will eventually lead to astronomically high astronomically high oil prices, yes, but astronomically high gold and silver prices as well. Here's silver. Speaking of silver, silver is really, really pushing a boundary here, and we're about to break out. This is a big breakout if we get this, guys. And I think we're about to break. I think it has everything to do with what's above. And I think we're going to engage a monster pattern with the bigger cup and handle pattern. That's the 50-year cup and year handle pattern there. This is going to be insane. It's going to be insane. U.S. gasoline storage, if you just use gasoline, it says the gasoline surplus we started the year is now gone, and we're continuing to draw down. That's also why we've got large crack spreads, is because our gasoline storage, which is inventory, is declining. We are literally declining everything that is buffering the system. When this gets to critical levels, we are going to go vertical, Goose. We're going to go vertical in the price of everything. So get ready. 6 trading days to confirm one of the most important signals in 50 years for silver. And this is the early breakout line that's basically turtle heading out right now. If we can close the month and the quarter in about 6 days, oh man, we are going to be. This is a confirmed breakout. We're ready to roll, guys. And again, it's only happened 3 times in 50 years. These big breakouts like this. So get ready. It's coming. Tavi said, if easy monetary conditions with inflation reaccelerate and is the next move, then this is probably the most compelling setup to own hard assets that I've ever seen. Well, I agree with that. So inflation expectations versus financial conditions. Inflation expectations are going up, and loosening monetary conditions are occurring at the same time. This is a very rare setup that basically I've been waiting for. Bullish, says Eric Nuttall. Crude, gasoline, distillate all mixed together. There we are on the low end of it. This is the average above us. We're kind of on the lower end. U.S. commercial crude inventories, excluding that, we're kind of slightly below the middle. And then This is your deficits, U.S. crude oil inventory deficit. And you can see we're running deficits ever since 2021. Big deficits, drawing down our inventory levels. At some point, we're going to get to critical inventory levels, and then the price will move. We don't have a strong economy. We have strong inflation. Inflation, especially underreported inflation, creates the illusion of economic growth. Academics, Wall Street strategists, and journalists who really don't understand inflation are easily fooled. The public isn't. Yeah, we definitely have inflation. And if we have a hang up in our energy delivery system, wherever it is, if we have problems with oil or nat gas or anything, inflation is going to be really bad. Really, really, really bad. North Star says silver, the coming resolution to a 45-year cup and handle is likely to be one for the record books. I agree with that. Here's the big cup, and then there's the handle. And we also have another cup and handle there, too. Looking good. Eric says, while $80 WTI remains our base case for 24-25, in investment selection, there's increased talk of 90 plus this summer. Why? Even assuming demand growth well below OPEC's forecast, inventory draws beginning in June look to take global oil inventories despite having absorbed 268 million barrels out of that, net barrels from the Strategic Petroleum Reserve. We expect OPEC Saudi to be able to begin to return curtailed volumes into the market in the second half. And oddly, more supply could be bullish, or at least neutral to price, as the market's focus will begin to shift to falling OPEC spare capacity, combined with meaningfully lower U.S. production growth in 2024 and going forward. All the while, demand continues to hit record highs. These are the deficits that we are running. We're going to draw down inventories and the deficits that he expects to come over the next, I would say, 20, 30 weeks. We've got housing completions rose in February to their highest since January of 2007. Remember, we were overbuilding here. The problem is now is that we're not overbuilding. The completions are up to 1.729 million, guys. This is in big expansionary phase. This is going to be very inflationary. It's starting. The thesis of the housing market driving inflation is it's with us right now. I like it. Oil inventories held flat when they would normally have increased. One wonders how inventories will change going into a period of increased consumption. Again, I'm watching inventories and oil a lot. Here is, it says, if you like RRG charts and energy, you'll love this analysis of the ongoing sector rotation into XLE, XOP, PSCE, OIH, XES, etc. So when we look at this, this is the rotation graph. You go from leading to weakening to lagging, and then you swing back up to improving. And you want to go from improving to leading. XLE is doing that. And we're seeing not just XLE, but XOP and all those other ones. We are starting to go to improving, and eventually we'll go to leading. We have a long way to go as this thing rotates around. Other sectors are starting to lag and start going to the weakening and lagging sector, like the financials and some of these other ones. WCS, Western Canadian Select differentials, as of Tuesday, settled now tightened to 13 barrels. So this is the difference between the Western Connect WCS, which is Western Canada Select or whatever it's called, to West Texas Intermediate. And you can see that we squeezed up to minus 10, and now we're at minus 13, which will probably squeeze in the summer months. Brady says, if you cannot control your burning, longing feelings to be financially free, you will never get there. Then you will take too big risks at the wrong time all the time. You have to wait for the proper setups and then manage the position. You have to control your money stress, is his opinions. We've got the CPI versus PPI, and I know people have seen me do this chart as well. I do PPI to CPI ratio, but he did CPI to PPI. So gold price is strongly correlated to the movement of CPI versus PPI. Based on the chart evidence, I expect the producer price index to outpace the consumer price index in coming years as gold's value rises sharply. And I do think we're going to move way down. And I even think we're going to break this line potentially. Maybe. Depends on what oil does. Feel like I went to the wrong location there. 1 second, guys. So here we go. Well, folks, today the supply-demand fundamentals supporting a decade-long bull run for uranium mining stocks are the best in 50 years, going all the way back to the first nuclear renaissance of the 1970s. Never in my wildest imagination did I see this day coming when I started researching, investing in, and posting about uranium stocks in my retirement hobby over 12 years ago. You might not see it, but those of us who survived the decade-long bear market from 11 to 21 are having our minds blown every day now, with news of a world where a pendulum has swung back to embrace nuclear as the key to a future powered by safe, 24/7 reliable, carbon-free, energy fueled by the most energy-dense power source on the planet. The uranium investing thesis we built many years ago did not need a major nuclear resurgence or net zero or climate change or energy security or a bifurcated market where the West was going to give up cheap Russian uranium as a major source of reactor fuel and even move to ban imports from Russia. The thesis does not rely on or expect skyrocketing electricity demand from cryptocurrency mining, electric vehicles charging, or today's exploding demand for large data centers running on carbon-free nuclear for e-commerce, social media, and the latest energy-intensive application artificial intelligence. Nor does the thesis depend on the newly arising global demand to decarbonize energy use far beyond nuclear's traditional role of providing stable, 24/7 reliable baseload electricity. Transportation, heat, processes, heavy industry, seawater desalination, for drinking water and agriculture, green hydrogen and petrochemical industries are now all looking at nuclear to achieve net zero emissions goals in sectors where intermittent, unreliable, weather-dependent solar and wind are useless. Today, nations that had previously pledged to phase out all of their nuclear reactors, except for Germany, are now reversing those misguided ideology-based policies to embrace science. Not only are we keeping the existing reactors operating decades longer than planned, but we are announcing new reactor builds, supporting new advanced SMRs, and joining the absolutely mind-blowing COP28 pledge to triple global nuclear power generating capacity by 2050. Never in a million years did we see that coming. The science is clear. Nuclear reactors are capable of operating for 100 years or longer, producing the safest, lowest cost form of continuous 24/7 carbon-free energy that can be used in hundreds of applications that we have until now relied on burning of fossil fuels. The world is finally catching on to what uranium mining stock investors have known for decades. This global energy epiphany was totally unexpected. No, I'll skip that one there, and I'll end it there. There's a lot there. Let's go to the charts here. Inflation-adjusted spot price continuing to move on up. It looks great. We've got forecast structural supply shortage, big gap between demand and supply, and that doesn't ever really cross until we start making some new mines. Coming over here, this is the utility uncovered uranium requirements. Your requirements are way up here, non-US and United States, and these are all uncovered. 2.2 billion pounds through 2040. And then we've got the million pounds of U3O8 utility term, utility spot. And that's what it looks like right now. Coming on back. It won't be a straight line, but we are entering the strong seasonality for oil and energy companies. So WTI crude futures seasonality, we're coming into strength, guys. Here is Grady. He says the inflationary 1970s caused a huge rise in gold. when called, the commodities bear market low back in April of 2020 also said we're in for big inflation. It is time for that next huge historical inflationary pause. Yes, the clearly wild chart, but quite likely. So here's this wildly bullish call on gold. This is a 50-year candlestick chart. We got the 1970s, which is the first bull phase. The second bull phase says the largest, very probable bullish rising wedge continuation halfway pattern I've ever seen. Then the third bull phase is the inflationary 2020s. He says this wild chart does say that the target is $48,000 an ounce, which would be the approximate number if USD was backed. The M2 money supply was backed 100% by gold. And then he says the MACD not crossing down during that 8-year cycle decline into 2015 8-year cycle low was bullish. We have a volume that dropped downward on the back test. So that is his ultimate bullish target based off of the rising wedge and this continuation move. What could drive that? I will tell you what will drive that. If oil goes into a shortage and we cannot produce the world's oil supply, people are going to run into gold and silver and other precious metals to preserve purchasing power because they become afraid of bonds and currencies. That is my opinion on it. Jeffrey Curry says, being short oil and commodities in a late cycle expansion is like being short natural gas in a blizzard. That's his opinions there. He says, I want to be long oil and the rest of the commodity complex in this environment, says Jeff Curry. There's another one. And that is what I've got for today, guys. So if you like the content, give me a thumb up, subscribe to the channel, subscribe to the website if you'd like. We still have LEAP, the coupon code coming on, LEAP. It is leap year. That's where it came from. 50% off the first month if you want to try it. You can also go to the yearly membership and save more money if you use that coupon code. And we have a question and answer session coming up on Sunday at 5 p.m. I'll see you there. And that's all I've got for today. This is Finding Value.